We're about an hour into the trading day. Stocks higher as earnings continue to really drive the market action. The big banks reporting strength in trading activity, deal making, and consumer spending, and that's signaling that the economy remains resilient. Earnings, along with the September jobs and inflation reports, causing some investors to consider the possibility of a no-landing scenario. Here to discuss what this means for the markets, we want to bring in Collin Martin. He is a Schwab Center for Financial Research, a fixed income strategist. We also have Kinahan joining us on set, IG North America's CEO. Great to have both of you, Collin and JJ, let me start with you. When we talk about some of the fear, some of the worry that had been baked into, or one of the fears, I should say, out there in the market was their narrowness, the fact that we weren't seeing broader participation. We started to see that creep in just a bit, and then we had the sell-off in some of the global chip stocks yesterday that sparked some of those concerns. How should investors be thinking about the current setup?
Well, I think it's been, to your point, interesting. And when we saw the rally at the end of August, beginning of September, what I thought was really interesting is we started to see the names sort of widen out a little bit, and that's always a good sign. But at the end of the day, the one reason I think this rally can continue is because we're at a wall of worry, if you will. Nobody believes in a rally. And so with that, the chip stocks, what I find incredibly interesting, and this makes a lot of sense, if I look at the names there, people have obviously the NVIDIAs of the world everybody wants to own, but one of our biggest on our tasty trade end, one of the stocks that's been sold the most over the last 2 weeks has been Intel. People very bearish on Intel going forward, and it kind of makes sense. You look at the chart, yeah, they had a couple of weeks here that have been okay, but people are not saying, oh, okay, here's another chip stock I have to buy. They're saying they've had a couple of nice weeks, let's sell it. And so it'll be interesting to see when a Dow restacks, if you will, if Intel remains in the Dow overall, first of all. And second of all, as I said, I just think it's really surprising that there's one chip stock that's sort of the outlier. People run to the other chip stocks when they sell off, but not to Intel.
And Collin, to bring you in the conversation, focusing on the fixed income side of the trade, we have seen a bit of a pullback in yields. Again, a bit of a dip lower here today, but we're still holding above that 4% level. I'm curious, how are you looking at the recent action that we've been seeing within the bond market, maybe what that could signal about the volatility or how investors are positioning here for the months ahead?
Well, I think with the recent decline in yields, maybe it showed the markets got a little bit ahead of themselves when we saw the 10-year yield touch 4.1% or so. But you could argue that the move was justified. We've seen a lot of strong economic data over the past handful of weeks, which is a good thing. I think if we take a step back and really look at the state of the economy, things are going pretty well. You mentioned before the idea of a potential no-landing economy. We're still in the soft landing camp where growth is still strong. The economy remains resilient. We're not expecting a re-acceleration in growth, though. So maybe 2%, maybe a little bit more than 2% over the near term, but inflation should still continue to move down. If we look at what that's done for the Treasury market, yes, we have seen yields surge relatively higher after that strong payrolls report, but we're not expecting a significant move up even more. When we look at what the fair value is of the 10-year Treasury yield, we think it's really in that 3.75% to 4% area, mainly based on our expectations of where the Fed is eventually going to get to once these rate cuts continue. We think if the Fed gets in the 3 to 3.5% range, a positively sloped yield curve makes a lot of sense. Again, if we have a strong, resilient economy, the yield curve should be positively sloped, and we get kind of a landing place near 4%. So we'll probably see some choppiness from here and there, given how much focus we're putting on in the immediate here and now data. Good data will probably send yields a little bit higher. Disappointing data might pull a little bit lower, but we'll probably see most yields trade around this 4% level for the near term.
Do you agree with that, JJ? You've been shaking your head as Collin has been talking a little bit here. And I guess, how are you viewing maybe the slight uptick that we have been seeing within volatility?
Yeah, so I think going into an election, going into some unknown, it makes sense that we'd see, if you remember, if I look at the VIX as the measure, trading near 20, it's historical norms. Right. So it doesn't surprise me at all. And we just did an internal study. It showed that volatility actually does not increase going into elections, where it tends to increase is the year after the election. So I would look for volatility to really start to increase more in January. One of the things Collin said, though, that I think is really interesting, and you, again, referred to the no landing, which I like that terminology, is if I look at retailers, what I really find interesting is our retail client behavior for one thing. They're selling Walmart and they're buying Amazon. And you might say on its surface, well, it makes no sense if the consumer's healthy, why they would sell Walmart. But the other stock they're also buying is Nordstrom. I think what the retail client is saying is they expect people to step up a little bit. As much as we've been saying that the economy's terrible, et cetera, we are seeing people saying, okay, maybe they're moving up in quality a little bit. Amazon obviously has a lot of other businesses besides the retailing end, but when I see them buying Amazon, buying a stock like Nordstrom, selling a stock like Walmart, I say, are people seeing something out there that perhaps the rest of us are maybe missing a little bit in terms of where they see the consumer going for the next few months?
That is a very interesting point. I guess, Collin, to bring this into the fixed income landscape, the bond market landscape, I guess, how much are you factoring in the Fed's future moves? How much does it matter whether or not they go 25 basis point at the next meeting, as we are trying to figure out just how resilient or on shaky grounds the economy is?
I'm not sure how much every meeting's decision is going to impact the market, but the ultimate landing place, I think, is going to be very important. If we look ahead to the last two meetings of this year, we still do think they'll cut rates. It seems likely that they'll cut in the November meeting. Looking ahead to December, I think it's not as certain there, mainly because we have seen this strong patch of economic data. And if inflation is proving to be a little bit stickier, we saw a strong CPI report last week. We're seeing employment indicators that are still relatively strong. But the case can certainly be made that the Fed maybe pauses later in the year. What that means for the other parts of the bond market, if we in the markets come around to the view that the Fed isn't going to cut as much as expected, and they don't get to 3.5% or below, and they only get to 4% or below because the economy remains resilient, we'd probably see yields move a little bit higher from there. Again, when the economy is strong, we should see a positively sloped yield curve. So that would likely allow yields pretty much all across the curve to drift higher. It's not our base case, but if we were to get this re-acceleration in growth and inflation, then we'd probably see yields drift up from here.
JJ, as we wrap up here, we have 2.5 months to go between now and the end of the year. What's the number one thing that you think investors should keep in mind here over the next couple months?
So I think people always try to pick elections and say, oh, this will definitely happen, What I would say to most people is, if you really feel strongly one way or the other, you want to move part of your portfolio into a sector, into a stock, you think because of one candidate or the other will do better, that's great. But you always have to be careful because, again, remember, the president sets the agenda, but things still have to go through Congress. And I've seen too many times in my career where people are like, oh, this person's getting elected, so this is definitely going to happen. Things tend to get watered down a little bit as it goes through Congress, so just be careful of going into that mindset, and that's what kind of concerns me the most for people heading into the end of the year.
All right, JJ Kinahan, great to have you here on
Always a
set.
pleasure,
Collin
Sean.
Martin, great to speak with you. Thank you both so much for joining me here this morning.